Good morning and welcome to this Wednesday, September 1st, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. I woke up this morning, September 1st. Wow. Hard to believe. I mean, summer now, close to being in the rearview mirror, getting closer and closer to the end of 2021, just 4 more months to go. And September, of course, if you think historically about the market, this is the 1 month of the 12 since 1950 where we've seen the S&P 500 end the month down more often than it goes up. So historically, I know a lot of folks always think about October being the worst month for the market because we had the market crash in 1987. Of course, we had 1929. All of that, folks just think about October, but historically, actually the worst month is September, and we'll see what happens. Technically couldn't be in much better shape. I pour through all my charts, and, everyone wants to continue to call for tops in the market. I just don't see it. I'm not seeing it right now. Outside of, if we get a pullback, I wouldn't expect it to last more than 1 to 3 days tops. And then I'd expect it to go right back up again. I'm just not seeing any kind of significant selling on the horizon. Now, of course, that means probably going to have a sell-off, but that's the way the market goes. But this is different than a year ago. 1 year ago, I wrote that article in my blog, I think it was on September 3rd, and I talked about a lot of the warning signs that were out there, especially with the sentiment readings. And those same sentiment issues are not present. You could maybe argue a little bit of negative divergence on a 60-minute chart, but again, that we're talking about a 1 to 3 day kind of a pullback, if that ever even kicks in. Now today, this morning, looking at futures, Dow futures up almost 100 points, S&P 15, NASDAQ 50. Here we go again to the upside. So I would not be betting against this market. I know historically September can be weak, and I get questions, how do you reconcile? Well, technicals are going to look different every day. Technicals pay no attention whatsoever to history. So we're going to get two different and objective looks at the market. One that simply goes back and looks at history and says, this is what has happened. And then technically, we're looking at charts that are saying, hey, this is how it looks right now. And I favor technicals over historical patterns. Always favor always favor the technicals. So I'm bullish heading into September. I'm aware of the historical bearishness. So I wouldn't be surprised if September finished down. I certainly wouldn't be shocked. That's kind of a historical pattern, but I'm not expecting it right now, not based on what I'm seeing on the charts. But we'll talk more about that as we go throughout the show. Let me first take you over to Earnings Beats, those of you who are new. Love to have you check out our site. We've got a free 30-day trial that you can click on there, right homepage at the top. But I'd really like to just have you learn more about, if you're not familiar with Earnings Beats, just learn more about what we do. And I think perfect way to do that is sign up for our free newsletter. This is published 3 times a week, Mondays, Wednesdays, Fridays. Simply type in your name, email address there, hit that subscribe button. We'll get you set up. No credit card required. You can unsubscribe at any time. And it literally just talks about the things that are important to us. And it's very readable in 2 minutes every day. Comes out before the market opens. It should be either educational or possibly a trade candidate if you're in, if that's what you really desire, is looking for possibilities of trading. Some might be on the long side, some might be on the short side. This morning in our EB Digest, I featured a company that was about to report earnings. They actually reported this morning, and just talked about the things that I don't like to see in an earnings report or in a chart before the earnings report comes out. Things that would keep me out of a stock. So if you're wondering, well, how can you tell what kind of earnings report's about to hit? Well, you never know for sure. There's no guarantee. But I do think that there are a lot of clues in the chart, and talked about some of those this morning. So it's just those types of things. Again, helps you understand a little bit about where we're coming from. All right, let me take you now over, take a look at what happened on Tuesday. So we had the Dow Jones Industrial Average down 39 points, S&P down 6, NASDAQ down 6, mid caps down 7, small caps up a fraction, less than 1%, or right around, not 1%, 1/100th of 1%. So literally fractionally up. But for the most part, the market was just flat. Not really seeing a whole lot there in terms of sector leadership. Real estate broke out. You can see the last few days coming off the 20-day moving average, moving up to new highs. So real estate looking better again. Communication services, discretionary, and staples were your next in line. So these were 4 groups that went higher, ranging from 0.6% down to 0.2%. But it was encouraging to see both of the consumer groups moving higher. And then on the flip side, the group that underperformed on Tuesday was energy. And we had mostly a split, a little bit more strength than weakness among our sectors, but definitely a bifurcated market, in that we did have some decent strength. And if you look, these two right here in particular, communication services and discretionary, these two are among our 5 aggressive sectors. So I'd like to see some of the aggressive sectors up near the top of the leaderboard. So that was good. Moving on to the 10-year Treasury yield, and we do have some economic reports out this morning. One already out, August ADP employment report. This is the first of 2 key employment reports out this week. Of course, we'll have non-farm payrolls on Friday, and I would certainly say that's the one that's most closely watched. But this gives us a little bit of a precursor maybe as to what we might expect on Friday. And the ADP employment report showed 374,000 jobs. Market was expecting 500,000. So came up short, but still very solid growth. I honestly think that that's more nirvana for the market. I would rather see a strong report, but a little less than expectations, rather than a strong report where you're blowing away expectations. Because once you start seeing the blowing away of expectations, that makes you think, okay, the economy's overheating. Might have inflation, yields may start to rise as a result as folks jump out of bonds. And that in turn, depending on what the reasoning is, if folks are thinking inflation, that's not a good thing for stocks. If they're just thinking, hey, the economy's picking up, but inflation will be fine, then that rotation away from the bond market tends to be very solid for equity. So it's just hard to put together exactly how the market's going to interpret it. But generally, I look at a lot of these reports. You want to see reports of a strength in the economy, but not too much of a strength in the economy, if that makes any sense. Later this morning, August PMI and August ISM manufacturing reports will be out. Both are expected to fall a little bit from July. The August PMI manufacturing was 63 point, or excuse me, the July PMI manufacturing was 63.4. And we're expecting August to drop back to 61.2. July ISM manufacturing was 59.5, and we're looking for a little more modest drop in August to 59.0. And then July construction spending, not sure how many folks are looking at that now that we're into September, but July construction spending is expected to come in with a rise of 0.3%. June was 0.1%. As you look at the 10-year Treasury yield, though, let me update. We'll get the latest, make sure we got the latest. And we're down 1 basis point today. Seems like we've kind of rolled over again. And as I was mentioning yesterday on my show over at Stock Charts TV, it seems like now we're moving up and down above and below the moving average. Notice when we're trending lower, we tend to stay below that 20-day. When we're trending higher, we tend to stay above that 20-day, which in turn stays above the 50. When we're dropping, the 20 stays below the 50. You kind of see those dynamics in a trending higher, trending lower market. But when you're going nowhere, you just, like we saw back over the summer of last year, the moving averages don't seem to do anything. We just kind of going back and forth, and there's no real trend in place. And that is kind of poster child for a trendless market. A trendless market typically occurs with moving averages not doing anything. And that's what we seem to be doing again here in the near term. So as I look at this, I see overall longer term, I believe interest rates are going to go higher. If you look more at the shorter term, we've been downtrending. And I think if we just look at the really short term, just these last couple of weeks, I see trendless. I see the market trying to figure out which way it wants to go. So watch for a break either above 138, 1.38% to the upside, or maybe 1.3, 1.4 to the downside. In the meantime, I would just be looking for more of this sideways consolidation that we've seen for the past 6 weeks or so, maybe the last 4 weeks, really since we put in this double bottom. I think it was clearly a downtrend until we double bottomed. Now, looking down at the relative strength of both financials and industrials, and I like to put them on the same chart with 10-year Treasury yield, because if you look at the action, up and then back down, then choppy, up, back down, then choppy. This one not quite the same, but up, and then we kind of came back down like right in here. You can see, started pulling back, but a little bit choppier back in December and January. But anyway, we haven't turned back up again. Yields have turned up, but relative performance of industrials has not turned back up again. And we're heading into September. And the reason I mention that is I just want to point out that in September, you can see the industrials here have had a pretty good historical run over the last 9 years. This is since the secular bull market began. And I know we always have new folks listening, and I get this question a lot. Why would I suggest that the secular bull market began in 2013 when the market bottomed in 2009? Well, you don't know that bottom is in and it's confirmed bottom until you break out to new highs. A new trend doesn't start until you start to print new, higher highs. And so in 2013, April of 2013, that's when we took out on the S&P 500, that 2007 high and the 2000 high. That was the resistance and kept us in a secular bear market until we were able to break above it. And that occurred in 2013. So when I look at the secular bull market, what I'm looking at is 2013 to 2021. I don't really argue with those who say the bull market started in 2009. My only point is you didn't know it in 2009. Nobody held up a sign in March of 2009, said that, hey, we've bottomed, bull market starts here. I never saw that sign. Really, you don't see that until you get that breakout. And that's like a chart. A chart's consolidating until it breaks out. I don't look at a chart that's been consolidating for a year and breaks out to a new high. I don't go back to that most recent low and say, well, that's where the true start of this bull market and the stock began. You certainly don't say that's where you broke out, because you didn't. Anyway, looking at the historical performance of industrials since 2013 relative to the S&P 500, this is important, because when you start looking at these results down here, this isn't how industrials have performed on an absolute basis. This is how industrials have performed relative to the S&P 500. If you look at September and November, 100% of the months, or 100% of September's, 100% of November's have gone higher than the S&P 500 in terms of industrial performance. That's, doesn't mean it's going to happen again here in 2021. But I mean, if you look at the outperformance over a 3-month period, if you add these 3 numbers up down here at the bottom, this is the average monthly outperformance or underperformance of the S&P 500. If we add these 3 up coming across here, we get 3.5%. So over the last 9 years, with this being the 9th year, September through November, we've seen industrials outperform the S&P 500 by 3.5 percentage points. If you go back and you look at the rest of the year, it's probably negative, or I'm guessing it is negative. Let's see, that's 1.2, 1.4, that's 0.5. minus 0.4, minus 9, minus 1.4, minus 1.5. Yeah, minus 1 or minus 2.2. So September through November, industrials have outperformed by 3.5%. December through August, they've underperformed by 2.2%. That's been their history since we broke out back in April of 2013. Well, it's September 1st. So here you go. Is this going to hold up? I don't know. Historically, didn't look very good on that chart that we were looking at. You know, industrials underperforming for the last several weeks. Are they just going to turn on a dime now that we're into September? We're going to find out. All right, next thing I wanted to do today was to give you a very, 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 very quick synopsis of the Dow Jones moving average, or Dow Jones Industrial Average. And so the way I'm thinking about doing this a little differently today, of course, there's 30 stocks in the Dow. And if we pull up Candle Glance, we have 30 stocks, right? So let's do the Candle Glance, and we can take a look at all of the Dow component stocks at one time, which is kind of cool if you just want to see, you know, what's been leading the Dow visually. I mean, we could pull up the components, and I can tell you based on a summary, go back, look 1 month, 3 month, and so forth, and tell you what's been leading. But this is going to just visually give you an idea. Like first, I can look at Apple and say, wow, okay, Apple's been performing well. Amgen is not. Apple trending up, Amgen trending down. American Express more sideways. Boeing, maybe a little bit of slant to the downside. Caterpillar down. Salesforce.com been trending higher. Cisco looks good to me. Cisco with that nice move after reporting earnings. Made a nice run from about 54 and change up above 60, pulling back a little bit, but I think the overall trend here looks nice. Chevron downtrending. I know energy's been good last week and a half, maybe 2 weeks, but some of the energy stocks started rolling back over again. You got to be careful with energy. Disney definitely going just sideways. Dow mostly trending lower, trying to maybe have a little bit of a bounce here. Goldman Sachs trending higher. Home Depot, can't really see it, but this is off of a big uptrend. This is more of a cup, little handle that's been forming. I think a break below about 314, I'd be more cautious. Break out above 336 though, and I would be very bullish on Home Depot. So this one I look at more bullishly, mostly because I know what the longer term chart looks like. Honeywell trending higher, got to get through some resistance though. IBM, every time it looks like it's ready to get going, it's time to get out, basically, because that stock for the last decade just has done nothing. Intel, one of the weakest semiconductor stocks, continues to trend lower. I'd stay away. Johnson & Johnson trending higher, looks pretty good. This pullback, actually, I think looks pretty good. JP Morgan, mostly sideways, started to strengthen here a little bit in August. We'll see. Still got some work to do to break out above that early summer high. Coca-Cola trending higher. McDonald's, slight trend to the upside, I'd say. 3M, more sideways consolidation. Merck trending higher. Microsoft clearly trending higher. Nike trending higher. Procter & Gamble trending higher. This is noteworthy because many of the consumer staple stocks have been struggling, but PG doing pretty well. The other thing you can see on these charts, though, and maybe what makes things a little bit, I don't know, murkier for me, would be this AD line, which throughout this entire move to the upside, AD line's barely budged. So I don't know, maybe it's just getting a little bit of a bounce temporarily and it's not really going to stick. Doesn't seem to be a lot of accumulation taking place. Travelers, really nice move throughout most of August, pulled back a little bit recently, but I think this one looks pretty good. I'd be a buyer on that 20-day test. UNH trending higher. Visa looked pretty good heading into August, but kind of fell apart here in August, not looking particularly good now. Verizon trending lower. Walgreens, Boots Alliance, definitely looking horrible heading into August, but we have begun to recover a little bit. Still got a lot of work to do there. Walmart trending higher. So that was just a very quick analysis. Now, the other thing I mentioned was if you pull this up in summary form, you can go over here and pull up a 1 month chart. And this tells you which ones have actually been performing the best. So the ones we talked about outside of maybe Walgreens, which I wasn't a fan of, but it's had a strong last month. It just had dropped so much prior to that. I don't know if this is more of a, just a little Fibonacci retracement move back to the upside, or if this is truly going to be an uptrend. Of all these, I would say maybe in the top 10, Walgreens be the one that maybe would make me the most nervous. And that probably would show in the Scooter score as well. Scooter 47, Travelers 43. That's not the lowest. There's JP Morgan's 43. I like the other charts, even though the Scooters were a little lower. I like the other charts better than WBA. But you can do this on a 1 month basis. You want to see what happened last week? There's Walgreens leading last week. Want to go back 3 months? There you got Apple and Microsoft, Nike, 6 months, Cisco, Goldman Sachs. Just depends on your time frame, what you're looking at. Notice Walgreens is nowhere on this 6 month list, probably somewhere down at the bottom. Actually, it has made a move up 7%, but it's not too far from the bottom. Intel, over the last 6 months, worst performing stock in the Dow. Who would have thought that? Especially if I had told you that semiconductors were going to be setting new highs. Would you have ever thought that Intel would be leading the Dow to the downside? For whatever reason, Intel just not, Wall Street not interested in that company. And as long as Wall Street's not interested, I'm not interested. I'm not going to try and be a hero and catch the bottom. Now, for those who might be interested in how you can do this, how you can get all of the components in a chart list, what you can do is if you go to your dashboard, if you want any of the major indices components, just go down to your scans, hit new scan, and then you don't even need any of this stuff. All you need is come down over here, indexes. So if you want the Dow 30, just click on it, add it, and then run your scan. And there's your 30 stocks. And you just pick a chart list that you want to put it into. All right. So very easy. I like to do it because, if you go to your dashboard, you'll see things like market movers, large cap. Well, right here, let's pull up S&P 500. So you can get the percentage up and down, the leaders, the 10 leaders, the 10 laggards. But what about the other 480 companies? Well, if you just do what I did, just pull the S&P 500 up, you can download those right into a chart list. And then you can sort that any way you want or run scans against it, run scans against the S&P 500. Compare that list against another chart list you have. So in other words, I could run a chart list. I could run a scan. I'll show you one more scan. So if we come down here and grab new scan. So one thing I could do is say, okay, of all the stocks in our strong earnings chart list at earnings beats, and then of all the stocks in the S&P 500, which ones, where do we have common components? Now, this particular stock charts account that I'm using here, I don't know if I've updated because I just updated strong earnings chart list. I don't know if this one got updated or not. It may, I think it did. But if you run this, if you're a member at Earnings Beats and you run this, come up with different stocks, it's because I haven't updated the strong earnings chart list. But anyway, what I can do is just run a scan against 2 different chart lists. And what it'll do is it'll give me all the stocks that are in both lists. So if I want to see how many of the strong earnings are S&P 500 companies, I could just run this quick scan. And 230 of the stocks on our strong earnings chart list are in the S&P 500. And then I might just want to sort it by Scooter. And there you have the various stocks. Anyhow, I thought I'd point that out. Let's move on to earnings spotlight. I know I went really long on Monday, longest probably I ever did on the show. So I'm really going to try to time this so we'll be out here right at 9:30 when the market opens. In terms of earnings, first company that reported was last night anyway, CrowdStrike. Want to talk about this one. AD line strong. We broke out heading into their earnings report. Stock was performing, it had already broken out above the January, February tops back in June and July before we went into a quiet period. Of course, once a company's quarter ends and they're preparing to issue their quarterly report and their conference call, during that period from the quarter end until they release their earnings, they are in what's called a quiet period. Management cannot discuss earnings with anyone, especially the Wall Street investment community. So you go through a quiet period leading up to the earnings. So sometimes anything can kind of go during the quiet period. I try not to read too much into what happens either before or, right before they report. I tend to look more big picture. What has the stock been doing relative to its peers? And if you look at CrowdStrike, from that double bottom back in April, May, it had been trending mostly higher versus a very strong software stock or software group. You can see software versus the S&P 500 has been a leader since back in the early part of May. Very consistent strength. And during that period, CrowdStrike was actually moving up relative to software. So that was telling me we were probably going to see a strong report, which we did. They came out with their earnings, 11 cents versus 9 cents, and the stock promptly fell. This morning it's down 3% pre-market. I think that's an opportunity, by the way. I think any kind of a move back down to the 260, 265 area is actually a buy on CrowdStrike. Now, I think the last time I looked, it was around 271, 272. Last night after hours, when I looked, it was 268. It could dip into the 260s, but I would view that as an opportunity. Another company in the software space, this was a very strong reaction. And this is a company that had not been performing very well versus its peers. I would not have expected a big report, but they did come out. They posted a loss of 9 cents. Market was expecting a loss of 14 cents. And Anaplan is up 15.5% this morning. So we're looking at a move up probably close to the 70 area, about, somewhere up into this gap resistance zone. Where it goes from there is anybody's guess. Still got a lot of work to do to get back up to that February high, but definitely heading in the right direction with its earnings. PVH, wanted to mention this one. This is also a company reported yesterday after the bell. It's in the clothing and accessories area. They blew away their estimates, 272 versus 119, $2.72 in earnings. Market was expecting $1.19. Stock's up almost 10%. So it is looking to open somewhere around the 115 area. I think it's still bound within this sideways consolidation. I'm going to say 94 or so to the downside, and then to the upside, this high over here near 120. I would be looking, it's a very wide range, and it's been sideways consolidating for a while, but this does come off of an uptrend. So I expect eventually we'll break out. Last one I'll mention is the one I wrote about in the Earnings Beats Digest this morning. This is Campbell Soup. Tell you, AD line's been falling apart. The stock broke down from this sideways consolidation, and its relative strength versus its food products peers is horrible. And food products relative to the S&P 500 is horrible. So going into this report, I wouldn't have held. I wouldn't have expected much. They did actually beat, though, on the bottom line. I didn't see their top line. Bottom line, 55 cents versus 47. Stock up 1%. So maybe we're going to come up here and test the 20-day. I don't know. I think even, maybe a relief rally back to the 50-day wouldn't be a surprise. But getting back through all of this resistance, this used to be support, now it's resistance. I think 44, 45 is going to be a challenging area for Campbell Soup going forward. All right, let's move on to the 3 you must see, and let's wrap up the show. First stock I wanted to show you was Performance Food Group. So we are in the food retail, wholesale and retail area. Performance Food Group. I like the fact that it's broken this downtrend, is at least trending higher. AD lines coming up with it. I would just say, hey, probably got a little bit of resistance at 52.50 at that point, maybe pull back at that 20-day, and then we'll see where we go. But I do like to see character changes on charts, and that's what I'm seeing here with PFGC. STAA, this was a really big earnings report that came out. You look at this move, this hollow candle here. back on August 4th or 5th. They blew away their earnings, their revenues. They raised their guidance, had a huge day, couldn't break out though, worked their way all the way back down to gap support, and now it's starting to turn back up again. I love to trade these different gap support levels on earnings, and STAA bouncing off of gap support. I think it's going to break out. Close over 160 here would be bullish. Last chart I have for you is IRM. Market just opened. IRM, I love this uptrend followed by a cup handle back to the 20 and a breakout. And look at the breakout yesterday, confirmed with volume. To the downside, I think it could go as low as that 20-day moving average. I'd be a buyer on any weakness. I think this is a stock that measures up to roughly about $51 in the short term. It's not a fast mover, but I would say $51. So if you pull back, get into the 46s, you're looking at maybe a 10% move to the upside. All right, let's get a quick update, see what the market did at the open here. Futures were up and the market is up, although it's not up like it was. The Dow now down fractionally, down about a point. S&P up 7, NASDAQ up 47. NASDAQ was up a little bit more earlier, but you can see that relative strength. I wrote that in the daily market report yesterday. The NASDAQ relative to the S&P 500 is right up at a high, multi-month high. So the NASDAQ's been showing that leadership again, and that's bullish action for the market. So that's continuing today. Just wanted to point it out. Anyway, everybody have a great day. I'll be getting that daily market report out today pretty early. I got some things this afternoon to do, so expect that out early. I'll also be trying to get the seasonality report out very early, well, today at some point, hopefully before my afternoon meetings kick in. So with that, anyhow, everybody have a great day. And I'll be back tomorrow over at Stock Charts TV, 9 a.m. Eastern, recorded show. You can listen in by clicking on this Stock Charts TV link at the top at 9 o'clock. It'll take you right to the video, and I'd love to see you there. Everybody have a great day. Happy trading.